All right, y'all. We are live on this beautiful Wednesday afternoon. God bless everybody in the name of Jesus, Yeshua the Messiah. And it is that time again, guys. That's right. It is time for FOMC, baby. In just a few minutes, as you can see from this ticker, 11 minutes and 14 seconds, 13 as I speak, 12 now. Jerome Powell is going to be making a federal funds rate statement. The federal funds rate, that's right. How's inflation doing? How's the economy? Are we bullish on crypto? Are we dovish on the economy? Are we hawkish? And then half an hour after that, he's going to be doing a press conference. And as we know, this typically is a catalyst to massive amounts of volatility. In fact, I'm more excited now than I've ever been in my life. In fact, as you can see, I've drawn my hair out since this morning. That's how excited I am. I haven't gotten a haircut. No haircuts for us, guys. Now, we got to give a major shout out to everybody in the chat, man. This is going to be absolutely insane as we watch the Bitcoin price get a massive move to the upside. Wait, did I say massive move to the upside? Am I predicting a pump here? Look, here's the thing, guys. Most of the... Well, this is the CME group here. Pretty much baked into the cake right now is that interest rates are going to stay the same. So there's a few different scenarios, and we'll get into that in a second. But first, we got to give a major shout out to everybody in the chat, guys. Make sure to smash up the likes. If we can get 1,000 likes in half an hour, we're going to be giving away $1,000, all right? If you like money, like the video. Shout out to Matt CT. Shout out to Fruit Market. Shout out to Christian Churchill, who says foul. Shout out to Mark 3. Bro doesn't have a blue or a purple shirt, so we're staying neutral. Shout out to Jackboy TNP. Get your Depends ready, baby. Look, you're not bullish enough if you don't have your dang Depends diapers, all right? Link in the description, 10% back. You get 10% back, all right? You pee 7 ounces, you get 3 ounces back. 10%. Take your dang adult diapers, rip a piece off of that, baby. Put it in your dang pipe. We're going to smoke these Depends hopium. Look, I'm telling you, crypto turns you from a good upstanding person into this. And this is what crypto trading will do to you. Now look, Jerome Powell is going to be coming out. This is serious business. Jason, get your act together. Get your act together. This is some serious business, as we're here to watch the most volatile thing that's ever happened to us since the last FOMC. Alright, gotta give a major shout out to T in the chat. Shout out to Chipotagi P, who says pump song. XEMAX says you're not bullish enough, and Blockchain Cowboy says smash those dang likes. Shout out to British Gold and John Ploney. Shout out to John. Do I give exact trade setups in the VIP? I don't know. Is this an exact trade setup? It's up to you to determine that. Is this an exact trade setup here? Alright, in the Casper Crew VIP Discord. In the Casper Crew? In the Casper Crew VIP Discord, do we give exact setups in the Casper Crew VIP Discord? I don't know. Is that an exact setup? What about this? Exact setup? You tell me. I don't know. Exact setup? I don't know. How about this one? Exact setup? I don't know. Is it exact? I don't know. I'm not here to tell you that. Alright? You use your own discernment on that, all right? All us crypto YouTubers, you know, we're all just nut jobs. You can't trust anything we even say. Did I just sabotage Tino? I don't think so. I love Tino. Shout out to HFG. Shout out to Big Way. HFG says he gives them here for free, too. Sometimes I do, like when I'm just feeling good. And today, guys, I'm feeling pretty good. It must be all the hopium I'm smoking. In my Depends pipe. Major shout out to HFG. Shout out to Cipher Ryder. Shout out to Diana Madrigal, who says, no rate cuts today. Enjoy the dump. The dump. The dump. Oh my goodness, you almost made me fall off my treadmill. Shout out to Felipe Collin. The 3MN Bitcoin chart looks like Jerome Powell. The 3-minute Bitcoin chart looks like Jerome Powell. Shout out to Preparing for War. Shout out to Ardrosh CR. I need a shout out too, bro. I got you, man. Shout out to Around Town 27. Shout out to Parth. What's going on, Parth? Shout out to Wouter Weavers. All right, guys. There's a few very important things that we need to be aware of. All right. Number one, most people think the rates are going to stay the same. All right. Now, what does that mean? Well, it means when the announcement's made, probably we're not going to see much volatility. But then when the press conference starts, half an hour after that, the FOMC press conference, then we're going to see how Jerome Powell's feeling. Because if he's feeling the way we're feeling, all right, that means he might really start cutting rates in the fall. And as we know, as it pertains to crypto, we're in the last 6 months of an epic bull run. All right, an epic bull run. And typically what happens is, during the last 6 months, the fundamentals line up perfectly with the technicals to give us a big old pumperoni and cheese. And we have just broken out of the range. We've just broken out of the range, as you can see, and we're about to close in 1 day and 7 hours a monthly candle above the previous range high, which is very, very bullish. In addition to this, all altcoin charts right now are looking insanely bullish. Ethereum confirming green dots below the zero line on market Cipher B as we are about to close a monthly candle for the first time since 2000. We've never done it actually, for the first time in history, above this 4-year trend line. All right, Solana having taken the range low, about to confirm a green dot in the monthly time frame. Chainlink about to confirm a green dot in the monthly time frame. All right, XRP about to confirm a green dot in the monthly time frame with thick money flow. All right, Cardano breaking out of a falling wedge cup and handle, about to make a new all-time high, about to print a green dot in the monthly time frame. Things are looking pretty bullish. All right, so this could really be a catalyst that leads us to a pump within the next few months. Now, could we have some short-term volatility, short-term dumpage? Of course, and that's why we're here. We're here because we want the volatility, a trader's best friend. All right? Shout out to Rational Evidence. I don't know what you're trying to say, bro, but yeah, God bless all the children. You know, kids are a huge blessing. All right? Shout out to Heavy Machine Gun. It will pump either way. It's about clarity, not a rate cut. Always the same in the bull. Exactly. But if we do get rate cuts, that would assist the bull, in my opinion. All right? Link and Soul joining for the DeFi realm. Shout out to, yeah, AVAX, man. AVAX looking juicy. Shout out to Jojo the Terrible. Hit the like and show some love to Jason. Guys, hit the like if everybody likes the video. Right now, we can give away 1,000 USDT. All right, shout out to Mr. Redbeard59. Jason just drank some G Fuel and creatine and walked 10,000 steps midday. Texas heat. Love much, brother. Well, God bless you, man. Look, I didn't drink any creatine and I didn't drink any G Fuel either. All right, I'm running right now on pure blueberries. Pure blueberries. Shout out to Felipe, as usual, a Nothing Burger. Man, I don't know. I'm feeling a little bit different today. Shout out to Spicy Noodle, pump and dump incoming. We're going to get, see, typically what happens is this. As we are very close. Oh my goodness, guys. 3 minutes away. Oh my. 3 minutes away. As we are very close to this, typically we get a pump and dump or dump and pump. We're going to get a wick, all right? We're going to get a wick, and then the press conference is going to come. And that's when we choose usually a direction. So we're going to be zoomed in here, guys, on our 1 minute time frame. We're going to be looking at Bitcoin. We're going to be looking at the stock market. We're going to be looking at the dollar. All right, let's pop on over as we await this to our actual chart here. And we'll get on good old-fashioned, what is it called again? Forex Factory. All right, we're going to zoom in on this minute here. All right, guys, I've got butterflies. I don't know about y'all, but I've got some serious butterflies right now. Make sure to like, make sure to subscribe, guys. If everyone likes the video, within the next 13 minutes, we're going to be giving away $1,000, okay? Now get ready. We've got the volatility about to ensue. All right, remember also, we are currently right now trading within a large pattern known as a symmetrical triangle, all right? Man, I have more adrenaline right now, guys. I have to be honest. I don't even know if I could keep walking on the treadmill with the heart rate is faster right now than it was that time that I almost got arrested for driving and trading, and I was running away from the cops, trying to take profit on my short trade, wife and kids in the car, huge cop chase. It was crazy, okay? So we got about 2 minutes left right now, and yeah, how's the sound? We gotta do a mic check. Mic check, 1, 2. Mic check. How's mic? I think the mic's good. All right, we can get back to the charts right now. Audio's good. The mic is good. Everything's good. How's everybody in the dang chat? Shout out to Blockchain Cowboy. Shout out to Random Stuff TV. Altcoin season postponed. You really think that? All right. My belly is to the moon. Crypto Incognito says, what the heck, baby? Shout out to Jackboy TNP. Saw Trump and Powell interview. Powell looked like a scolded little naughty boy. Yeah, that was such an interesting thing. Trump walking through the Fed. I feel like that has to be scripted, all right? But maybe I'm just a little bit too conspiratorial. You know what I'm saying? Maybe I'm just maybe I'm too out there, right? The hair's too long. You know what I'm saying? Shout out to Splashfire Films. God bless you, bro. Shout out to Ja'Aman123 and Mikey Mike FR. He's good too. Shout out to Mikey Mike. Is also good. Give me that flute, baby. We got the flute in the background. 44 seconds left. We got a little bit of flute. All right, here we go, baby. Local CBD looks bullish. Let's check it out. Let's check out the local CBD right now. How's the local CBD looking? Yeah, I mean, it looks bullish, but the open interest is coming down. All right, so here we go. Let's get ready. Let's get ready for the, I'm feeling it, man. I'm feeling it. I'm feeling it. We got 8 seconds left. I'm so excited. I gotta calm down. Hold up. Here we go. All right, here we go. Okay, here it comes, baby. Here comes the big move. We've been waiting for it. We've been waiting. Here we go. Oh, man, here it is. Any second. Oh, and the interest rates stay the same, exactly as predicted. Yay! Hooray! Okay, look at the big move popping on in, baby. We'll go down to our 5 second to really look at this. Exactly as predicted, 5 second pumping, baby. Look at the blue candles. Oh my goodness. Wow. We've been waiting and here we are. This is the moment. Oh, we were all right. We were all right. See? Whoever said dump. I told you. Oh no. A little bit of purple candles coming in. Let's check out the order flow. How's it going here? Let's see the actual live order book to see what's really going on here, all right? Let's investigate this. We're coming into VWAP on a decrease of open interest. A tiny little wick. A tiny little nothing. A tiny little nothing burger. Oh, no! We got the purple candles coming in. Let's see how the dollar's reacting to this. Let's see how the stock market is reacting to this as well. So, first of all, we're going to go to the S&P 500. Same deal. Wick up. Now we're getting a little bit moved back to the downside here. Ooh, S&P trying to push back to the upside. How's the dollar? Dollar dumping on the news, baby. All right, dollar is dumping on the news. Let's zoom out here on the dollar, the DXY, the old Dixie. The old Dixie. All right. Man, look at that. This is the dollar. This is some old stuff we had here a long time ago. This head and shoulders on the dollar from back in January, man. This thing played out pretty well. All right, so look at this. Look at this. In general, we can see the dollar losing some serious steam here as we are below the major support resistance flip. Overall, I feel like that's kind of bullish for crypto in general. Guys, check this out. Ethereum right now holding above the trend line as well. And we're going to get back to Bitcoin. All right. We are getting... Oh, no. Oh, no. Oh, no! Oh, no! Okay, relax, Jason, relax. Remember, it's not over until the press conference happens. Okay? It's not over until the press conference happens. Oh my goodness, guys. I'm going to need to take some deep breaths on this one here. I'm hoping that we're not going to go for the liquidity because, as we all know, everybody's 2,000 long X leverage right now. Okay, wow. All right, let's see what happens at the trend line. All right, oh no. Are we really getting a dump? Can it be true? Can it be true that we're getting a dump? Let's check out the order flow again. All right. Okay, so we've got shorts opening up and longs getting wrecked. Now, here's the thing. We have a lot of longs who opened up actually right here in this candle. 12 million of them who are currently underwater. A lot of longs still open here. A lot of longs still open underwater, and it looks like we're going to go squeeze them. It looks like we're going to go squeeze the longs, baby. All right, we're giving them that squeeze. We're giving them that extra cheese. Please, baby, please. All right, let's see. Oof. Now, remember, in half an hour, we got the press conference coming on in. Now, we got to take a look at this here, because remember, I am long on Bitcoin. Is the trade going to get stopped out? That's the big question. Is the trade going to get stopped out? That is the big question. Arpon says this guy gets too much excited. I am not too much excited, Arpon. Okay? I am not. All right? Man, people spreading lies about your boy, Jay Casper. We are not too excited. Hang on, let me take another big sip of coffee. Woo! Man, shout out to Seth. I'm gonna buy the dip. Yeah, let's see if we can buy the dip. Big flash crash is coming. Okay, now here's the deal, guys. We do start to get a big flash crash. This trade here could get stopped out. All right, but no need to fear. No need to fear. No need to worry. No need to fear. All right, because we are going to get a bounce, and the bounce is going to be big, and the bounce is going to be good. And we got 26 minutes until Jerome Powell is going to come with the press conference, and we're going to see, is he bullish, aka dovish? Is he bearish? Yeah. CY Beat says keep holding, 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 holding. Ah! All right. We got bold divs. Let's check it out. Do we got some bold divs? Let's check out the chart. Let's do some objective analysis here on the chart. Okay. Let's take a look. Do we have bullish divergence forming on our chart? Do we have any reason to expect a bounce? Now remember, we do have some trap longs at the top. All right. Let's see. Do we have we have trap longs at the top? Did we even take the low yet? We didn't even take that low yet, guys. This is nuts. If we do take the low, we will have some bullish divergences forming here. All right, we will have a nice, in fact, even if we go to the 1 hour, if we take the low, you'll see we'll have a nice juicy momentum wave, skinny momentum wave, the coveted uneven butt cheek pattern. You know, we've all seen it before. When you go to the diner, right, the waitress comes out with your coffee, smoking a cigarette inside like it's 1985. Price is dumping because interest rates stay the same, but you look at the booty, and you see that the left cheek is so big, the right cheek is so small, the price starts to move up again. We've all seen this when we've gone to the diner. Has anyone not seen this when they've gone to the diner? I always see this when I go to the diner. In fact, if I go to the diner and I don't see this, guess what? I walk out of that place. I don't go to the diner unless there's juicy, uneven butt-cheeked waitresses bringing me coffee. Because that's how I know we're going to pump the price. And when we pump the price, that means I'll be able to afford the dinner. And if not, I won't be able to afford it. I'll have to 100x leverage long a different time in order to afford that stack of pancakes with the simple carbohydrates that go straight to the... It will not change today, says Patrick Power. What will not change today? What will not change today? Uh-oh, Ace says don't give in to emotion. All right. Look, I'm trying to relax, guys. I'm trying not to trade with emotion. It's very, very difficult for me. All right, it's very, very difficult for me not to trade with emotion. All right, as we're waiting for Jerome Powell to come out and give us the press conference, all right, we got to just objectively look at this and understand that today really could be the day for the big catalyst for a large move. Here's why. Market structure is bullish, and this entire time, every time we get the big volatility, that's where the big move starts. All right, short-term big volatility, for example, a big flash crash right here. We had a big flash crash right here. We had a big flash crash right here. Those were all the opportunities to get into a long trade. All right, Casper Crew VIP Discord. All these circles you see on your chart are setups that we gave in advance in the community. Setup given, long trade taken, profits locked from $100,000. From 105, look at that juicy ninja entry right there. Told everyone when I longed, setup given in advance, all right? Currently long from $115,000, setup given in advance in the Jason Casper Crew VIP, jasoncaspertrading.com. All right, make sure to check it out, guys, if you're interested in trading these markets, okay? And so we need to think to ourselves, if we are going to get a flash crash, what is likely to happen here? What is likely to happen? Well, I'll be honest with you. I like the low at 115, but if we get a lower low than 115, then I think our big opportunity for Bitcoin is going to be coming in between 109 and 112, because this is the back test of the breakout. This is the big back test of the breakout. Look at this. We've got our value area high. We've got our support resistance flip. This is going to be the next big opportunity to long Bitcoin in the event of a flash crash into, my opinion, the top, which will come Q4 of 2025, probably at least to $130,000. All right. We also are coming to the month of August. August is a very important month. As we look at this uptrend, what have we seen historically throughout the month of August? We have seen this is where the low comes in. 2023, August was the low. 2024, August was that low before that big fall push. And so we really need to be watching for the breakout in the back test right now of this. All right, the breakout in the back test of this. Now, it's very interesting because the last time we broke out of a range, guys, all right, we broke out of this range here. We were looking for the back test. From the time Trump won the election, we were looking for the back test. People said we're never going to back test that, but we back test it perfectly. Now look at this. We break out of the range right here. All right, we were waiting for the back test. We back tested it perfectly. So that could be the next big opportunity right here. A back test of 109 to 112 for that last big push of the bull run. And again, so long as we're not losing this level, this is objectively speaking bullish market structure. Things look really bullish here. 2-week time frame looks insanely bullish for Bitcoin. The 2-day time frame, in my opinion, with that thickening money flow, is looking really good. That next green dot going to push us to the upside. 1 day looking pretty good as well. I know people could say, Jason, it looks bearish. I have a different view on the 1 day. All right, I feel like it looks like we're finding support here at the zero line on the money flow, and things are about to push back to the upside. I don't think we're going to lose $109,000 to $112,000. And if we do get a dump down there, I think within the next week or two, we're going to find a good local bottom. Could I be wrong? Yeah, could be wrong. But right now, the trend is bullish. We have confirmed bullishly for 3 weeks above the key resistance. We're about to close a monthly candle above the key resistance. The monthly time frame is bullish with the confirmed green dot. The 12-day time frame has room for more upside, but the money flow getting thicker. I think we got one more big push in us, and we have about 19 minutes here until Jerome Powell is about to give us the long and short. And if we zoom back in on our Bitcoin price here, you can see we're starting to get the big juicy blue. All right, look at this. In one 12-minute candle, we dumped all the way down, and now we're closing back to a blue doji. We're going to take a look at our 5-second time frame. Look at this volatility. I told you it was going to be volatile. People didn't believe me. They said it's going to be a nothing burger. Look at these major pumps and dumps right here on the 5-second time frame. Grok told you 2 hours ago there was no change in rates. That's funny. Shout out to J-Boy Bullish. He says, what's up, crew? Smash the likes. That's right, guys. Smash up the likes. Oh, man. Smash them up. Smash them up. We're so close to hitting 1,000 likes in half an hour that maybe we will do a giveaway anyway today. Even though we didn't meet our criteria, maybe we'll do a $500 giveaway. Let's wait and see how Jerome Powell is going to talk. Shout out to Constantine. He says, President Trump says he heard Fed Chair Powell will cut rates in September. Man, so this lines up nicely with our narrative here. We have a narrative of the August bounce leading into the bullish fall. If he really does cut rates in September, remember, the bull market top comes in 500 days after the halving every single time. Oh, not exactly 500 days, but around that zone. And so we had our halving, which was right here, April 2024, right around here. And 500 days after that will put us, oh my goodness. Oh my goodness. That will put us right in September. What do you know? Hang on, April, May. Yeah, let's see, about 500 days, give or take. Yeah, that'll put us right in the middle of September, guys. Right in the middle of September is where we can expect our all-time high for Bitcoin. Right in the middle of September. And you know what's crazy about that? If Jerome Powell is really going to be slashing rates. You know, it's so interesting. Look at this. This is quite interesting. If we take a trend line and connect it on these highs, let's see real quick here. I am just curious to see what happens if we take a trend line and connect these highs, because someone was telling me this morning the pi cycle is predicting 180,000 or something like that. They were telling me 180,000 was a pretty key area. I'm very curious to see. Oh wow. Oh wow. Oh my goodness. All right. Well, wow. Would you look at this, guys? Would you look at this, guys? We're actually, this is very provocative. We have gotten basically a double tap of the trend line, a fake out, and now a breakout. This could be intense, man. This could be intense. Again, I'm not expecting more than a $147,000 Bitcoin this cycle. I'm not. But the fact that we're breaking out of this trend line is quite interesting. And I do like to entertain the super cycle theories, even though I don't necessarily hold to them. The super cycle theories, you know, when you look back in time, the last time we saw anything close to this was back in 2015, where during the bull run we had like this channel, right? We had this channel. Again, I don't necessarily think this is going to happen, because I'm the kind of guy that likes to expect less and be happy with more. But we're seeing something very similar happen right now, where we are forming, this bull run has been characterized by this ascending channel, all right? In 2015, when we broke the channel, it was a big breakout. Do I think this is going to happen? Personally, I don't. Okay, I'm just being honest with you. I don't. But if it does, man, that could be pretty crazy. Let's go ahead and just connect these highs here. Man, that could be a $5 million Bitcoin, baby. All right, look, I'm kind of joking about that, okay? But we could see a break of that. That would be quite interesting. Let's connect these together and see what that would be. That would actually put us at a $280,000 Bitcoin by the middle of September. So in an insane event, in a very insane, in my opinion, very unlikely event, that would be pretty crazy if we broke this channel and just pumped to the upside like that. Now, I don't think this is going to happen, guys. But if it does, can you imagine that? Now, let's get back to Bitcoin on the low time frames. Let's see how we're doing here as we await Jerome Powell to give us his decision. All right. And again, if we're not going to hold this low that we put in at about 115, I have to expect that we're going to come down quite a bit lower here to backtest the support resistance flip, right, that we made here. I have to think that, because we have had our opportunity to really get a good bounce here. So if this is not going to hold, then we're coming back down quite a bit lower in order to get that nice juicy fake out scare before the big blast off. Before the big blast. All right, we've got 14 minutes until the big move. 14 minutes until Jerome Powell. All right. Shout out to Aaron G in the chat. The pump song today, maybe. We'll see what happens during Jerome Powell. Shout out to George. He says, we will all have to ride a bicycle top. Yeah, seriously. All right, shout out to Halva, who says, Ami din thrin akan dadamidin ambaga boomba, yeah? I'm not sure if I know the answer to your question. Shout out to Grunkle Ron Walker. Shout out to Seth Shepard. I'm bullish, guys. Market will start pricing in rate cuts for September. Market will dump into September. Don't sell and be a coward. Yeah, this is the pattern that we see pretty much every single August so far for the past 2 years during the bull run. We have seen that exact pattern play out. All right, let's check out forexfactory.com. We've got the FOMC press conference at 2:30. All right, and it is currently 2:18, so we got 12 minutes, guys. 12 minutes until Jerome Powell is going to start to tell us whether or not he's dovish. If he's dovish and it lines up with what DT says, Donald Trump, then, you know, we got ourselves a good old bullish scenario here. All right, shout out to Donald Trump.
Make sure to like and subscribe to Jason Casper. He's the best YouTube trader in the world. He's getting huge. Shout out to the Casper crew.
Hourly chart looks like a Bart Simpson. Yeah, so look, if this is a Bart Simpson, guess where we're going to Bart Simpson down to? The support resistance flip. All right, if this is a Bart Simpson, we're going to Bart Simpson down to the support resistance flip, and that's going to be an epic long. That's going to be the last juicy swing long opportunity of the bull run, in my opinion. And also, if altcoins take a dump, then it's going to be a really good opportunity to get things like XRP and AVAX and Cardano and Ethereum and Solana and all these types of things. Fed leaves rate unchanged. Yeah, the Orange Man does love the Casper crew. Captain Abby says, understand that rate cuts do not make your position as a worker better. If you want to benefit, then you obviously need to have the assets benefiting from the rate cut. Absolutely, this is 100% true. Rate cuts are really bad because that means your dollar will continue to lose value, right? But we here, we love rate cuts because we hate the dollar. And we don't consider the dollar a storage of value or storage of purchasing power. We just use the dollar when we need to get stuff, right, in real life. But then really you should be holding your assets in things like land and gold and crypto and things that are not affected by the dollar consistently losing value. All right, we were looking at the gold chart this morning. This is not the price. This is not the value of gold increasing. This is the value of the dollar decreasing. That's what this is. That's what this is a chart of. Back when the dollar was linked to gold, $20 was worth 1 ounce of gold. All right, this is constitutional money, gold and silver, okay? Then all of a sudden, 1913 Federal Reserve is created. Guess what? They start printing their phony debt notes. Then guess what happens? Great Depression, because there's funny money manipulation. Then look, the dollar's no longer linked to the price of gold. And then in 1971, when we completely go off the gold standard and just start having our money backed by literally nothing, the price of gold goes up 10,000%. That's actually how much the value of your dollar has gone down since 1971. Isn't that crazy? All right. The Fed only has one trick to keep this fake financial system afloat, and that's to print more money. Eventually, that's going to lead to hyperinflation. The only reason the Fed can do that now is because the dollar is still kind of the world reserve currency, even though that's quickly coming to an end. All right. So it's very interesting to sit back and watch to see what's going to happen. There's never been a fiat currency, and when I say fiat currency, I mean a currency that's not backed by tangible assets. There's never been a fiat currency in the history of the world that hasn't eventually hyperinflated. You can go all the way back to the Roman Empire. They devalued their own currency. They would collect the coins when they collected taxes, and they would file bits and pieces of silver out of the coins. They would literally devalue the currency. All right, and then eventually they started using fake metals in there, right? Oh, wow, that's what the United States did too with their coins. They used to be made of real silver and stuff like that. Now they're not, right? It's interesting how that happens. So we're gonna sit back and watch it play out, guys. But look, that's why we're in these markets in the first place, because this is the game that they play. The central bankers play this game where they just chart things out on paper and they can manipulate the prices and buy and sell with inside trading. And so they can make all the money while your average person gets absolutely screwed and loses everything, working more and more and more hours for less and less and less pay at their 9 to 5. I mean, it's so crazy to see how many hours some people are working and they can't even support their dang families. They have to have a second job, and their wife has to have a job, and their kids have to have a job, and they can't afford a house. It's crazy, okay? It's literally crazy. And so meanwhile, the banksters are getting all the real wealth because you can't afford a house. So guess what? The rich people buy a house and rent it to you. Now they're sucking out your fiat currency from your rent, and they're owning all the tangible assets, right? But if you understand these charts, you can play that game too. You can play that game too, and you realize money's fake, and it's just a numbers game, right? Now, we've got ourselves, yeah, we've reached 1,000 likes. Congratulations, we've reached 1,000 likes. We didn't do it in half an hour, but let's see what happens, because I'm feeling good. I might still do the giveaway, even though we did not meet the criteria. I might still do the giveaway if Jerome Powell says some things I like. If we get a nice pump up in here in the next 7 minutes, then I might still do the giveaway, you know? But this is the closest we've come in a long time to the giveaway. I'll tell you, you afternoon people really like to like more than those morning people. You morning people out there, you guys really, I'll tell you, don't like the video. You afternoon people, you guys like the video, man, I'll tell you. All right. We got nothing happening for Bitcoin here. We are waiting for Jerome Powell to start speeching. Look at this, though. We do have on the 6-minute time frame a little bit of some uneven butt cheekage, just a little bit here. Let's see what happens. Let's mark out some key levels here on the chart for when he starts speaking. All right. I'd say we do have to be aware of just the golden pocket 786 zone. We need to be aware of the liquidity at the low that we made at 115. Excuse me. We need to be aware of the low right here. And we also need to be aware of the low right down here. All right. Cool. We've got some key levels marked on the chart. I'm going to mark some key levels to the upside in the event of a big pump. All right. We've got our Fibonacci's here. I say these Fibonacci's are going to be pretty key. These Fibonacci's are going to be pretty dang key. Let's see what else we got on our chart here. We got our golden pocket up there. We've got this daily order block right here. All right, we've got some levels to be aware of here on the chart, guys. All right, these are the levels. Let's see what happens as JP starts his speech. Look at the daily money flow. Looking kind of good, though. I have to be honest. Daily money flow looking kind of good. Shout out to Rico. Shout out to Madi Z. How likely is it that the market will fall? What do you mean by fall? Like, I don't see a big pullback coming. I see a shakeout, but not a big pullback. All right. Pump Bitcoin and gold. Will I show in on screen? Show in what? Yeah, we're going to be watching the volatility on screen, man. We're going to be watching all of this on the screen. Shout out to Fees. We going to pump? No, we going to dump. Shout out to Dragos. He says it's morning where I'm at. It's morning where you're at. Shout out to Preparing for War. He wants to pump just so we could sing the pump song. Where am I from? Well, I did come from my parents. They came from their parents and so on and so forth. Shout out to Mike for the super chat. Please stop streaming early in the morning. Do the afternoon. Maybe someday, Mike. All right, maybe someday. Look, I'm in a little zone here of streaming in the morning. I just can't help it anymore. All right, I just can't help it anymore. But we'll see. We'll see what happens. All right, we'll see what happens. We'll see what happens. Maybe in the fall. Maybe in the fall, we'll start doing our afternoon streams again. Obviously, they're much better for the YouTube channel's growth to stream in the afternoon. You know, I've had my views get cut down like 70% just by streaming in the morning, and the rate of channel growth has slowed down quite a bit, about the same, about 70%. You know, I went from like getting 5,000 subscribers a month to getting like maybe 600 a month. It's because of the stream time and the short streams. But look, you know, life throws stuff at you. You got to work with what you got, man. You got to work with what you got. I started streaming early because of some crazy life circumstances that happened, personal things that happened in my family. And now I'm just in that routine, you know? Sometimes when you got a routine, you can't get out of the routine. Now shout out to Jerome Powell, who in half an hour is going to start. All right, and we've got ourselves the video, the live stream right here. All right, let's see. Man, this is so emotional, this music. It gets me every time. The music skipped. I was about to start singing about Jerome Powell.
Jerome, Jerome, Jerome. You know I love to see his face when he comes out of his place with the printing press going. You know Jerome gives me the look, and inside I'm feeling shook, because I hope that he will turn the rates to the next level. Jerome, whoa, Jerome, Jerome.
Okay, here we go. Looks like we're... Oh my goodness. Here it comes. I'm excited. Hang on, we'll get him on the screen. Give me a sec here. He's walking out.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is
He said short-lived.
persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Jerome with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September, monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but That's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But you know, if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So you know, that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? You know, it'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? You know, it's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. You know, it's, as I mentioned, you know, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and you know the Treasury only speaks to the dollar. It's not something that's been a topic of you know, major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
You know, we're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need, the government data really is the gold standard in data, and we need it to be, you know, to be good and be able to rely on it. And we're not going to be able to substitute for that, but you know, if we what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, so I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through
what is it up with these foreign questioners?
Rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level. And delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true. And it was, again, right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor force is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
MEXC.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then the next, and that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons, they'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because, inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Cox.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation because you're being pulled in two directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Wow. Wow, okay. Man. That's insane. That's pretty crazy. Alright. Let's get rid of that music here so I don't get more of a copyright. It's too late. I'm probably already getting a copyright. Oh man. I don't even know how to do that. Crap. How do I do it? How do I turn off the music? Oh, it's off. Okay. It's already off. Aha. Here we go. Close it on out. All right, so what's the deal? Well, I'd say the deal with Bitcoin is this, guys. We're bouncing from the 786. I think we're going to get a little bit of a bounce here. Then it does look like she does want to go for that low. I have to be honest with you. Looks like she wants to go for that low. So let's see what happens here. We're getting a little bit of a bounce from the 786. We had a whole bunch of dumb shorts open up at that low. Look at this, 12 million longing support. You never want to long support. That's a recipe for getting wrecked. Let me clean up this screen here, guys. Let's get some music back on. Let's get some music back on here. Whoa, 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 whoa. Oh man, I just blew my own ears out with that. Alright, we are back, baby. We are back, baby. Baby, baby, maybe. Maybe, baby. Alright, let's see what happens here. We're getting a little bit of a bounce from the 786, the 786. Let's see. Honestly, I think it's pretty neutral. I'm not necessarily scared of Bitcoin dumping here. I think if we do what I've drawn out here, we would have time to form some pretty bullish divergences at those lows, y'all. I think we'd have time to print some pretty bullish divs at those lows, y'all. All right. Well, you know what? I'm feeling in a pretty good mood today, man. I'm feeling in a pretty good mood today. I say we do a giveaway. What do you guys think? Should we do a giveaway? What do you guys think, chat? Should we do a $500 giveaway? We didn't meet our criteria for $1,000, but you know, let's do a $500 giveaway. How about that? How about that? Should we do a $500 giveaway? What do you guys have to say? $500 giveaway? What do you have to say? Let's see. What does the chat say? Looks like they want a giveaway. Wow, that's strange. I'm surprised people want money. That's weird. Okay, we want money. We want money. Okay. Alright, we'll do a $500 giveaway. Alright, here's what we're gonna do, man. Here's what we're gonna do. If you want money, what you gotta do is I just need you... First of all, like the video. Like the dang stream. Subscribe to the dang channel. Alright, subscribe to the dang channel. Let's see how many subscribers we got here. Let's see how many subscribers we got here. Oh, man. You know, I was really hoping we could have 154,000 subscribers. You know? I was really hoping we get 154,000 subscribers. We got 153,861. We need 140 subscribers. We got almost 2,000 people in the house. Alright? 2,000 people in the house. I think we can pump these subs up to 154,000 for a $500 giveaway. I think we could do it, man. I think we could do it. Wow. Look at Bitcoin losing that trend line. I think we could pump the subs, man. You guys think we could pump the subs? Watch this. We already pumped them 10, man. I think we could pump the subs. Can we pump the subs? You know? Look, the only reason we do this YouTube stuff in the first place is for the subscribers, you know? For the likes and the subs. That's the only reason we do it, man. Look at this. We already pumped them up an extra 2. Can we pump up the subs? What do you guys think, man? Let's ask the chat. Can we pump the subs? People are saying, yeah, we could pump the subs. Michael says he's in the members Discord and it's worth it. Well, I'm glad to hear you think it's worth it, man. Alright, let's see here. Let's see. It's 320. We're pretty close. Let's see. I think we could pump them up. Let's see. Let's see if we can't get them over the brink. Over the brink! 154,000. It's always been my dream to be a YouTuber. You know, when I was a kid, I always thought to myself, wouldn't it be great to be a YouTuber and wear a wig and a Casper Crew hat and fake glasses that came with a Sherlock Holmes costume on the internet in front of 2,000 people while you simultaneously reached 154,000 subscribers. Thought, yeah, that would be like the goal for me. Like, if I do that, I could be satisfied, right? There's nothing else in life I truly want to accomplish. So let's see, as we're getting our bounce from the 786, thinking we might take that low, but, you know, we're cautiously looking for a bounce here. Let's see. Can we get those subs pumped? It's a slow pump, guys. I don't know if we're going to do it. I don't know if we're going to do it. I don't know. I don't know. Just don't know. Why do I keep doing this? What the heck? Ooh, I got some violations. I got a warning. Violation. Ooh, harmful or dangerous content. What in the world? What is this here? That's crazy, man. Harmful or dangerous content? You guys see anything harmful or dangerous on this channel? Look, they're out for me, man. The Illuminati, they want my mind, soul, and body. Alright? Sam, he says, mic check. The VIP Discord should be the winner. Look, if you win $1,000, or if you win $500, that's a whole year of VIP Discord. Alright, that's a whole year of VIP Discord. You could put that right into the VIP, baby. Right into the VIP, baby. Alright, alright. Alright. Alright, guys, pump up the subs. We'll do a $500 giveaway, okay? We'll do a $500 giveaway. Here's what I need you to do. Go ahead and shill your Tether address in the chat, alright? Shill your Tether address in the chat. What I'm gonna do is, I'm gonna take a screenshot, count down from 10, and whoever's name is highlighted with their address, when I count down from 10, will win. Now, here's a rule. If you post big stuff like this, you lose. Alright, see this guy, RN? You post big stuff like this, you lose. See this, WakoZoo52? Your address only. If you post more than your address, you're disqualified, all right? Address only. More than the address, you're disqualified. Address only. More than the address, you're disqualified. Disqualified if you post more than the address. You're disqualified if you post more than the address. Oh my goodness, it's a me, Mario. It's a me, Mario. Pop, 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 pop. Okay, let's go. We'll give it some time for it to kick in. Okay. All right, you guys ready? We're going to count down from 10. 10! What the heck? 10! 9! 8! 7! 6! 5! 4! 3! 2! 1! All right. Let's see who our winner is. All right, let's see. Extreme Nova. Extreme Nova was screenshotted with the cursor highlighting. Extreme Nova. Congratulations, Extreme Nova. I'm going to go ahead and copy your address, text it to myself, and you have just won 500 United States tethered dollars. Okay? Congratulations. Wow, that was cool. That was awesome. Guys, what a great stream, man. Thank you guys so much for being here. Thank you so much for participating. I appreciate each and every one of you. Make sure to subscribe to the channel. Make sure to like, subscribe. May the Lord Jesus bless you all. And I'll see you guys next time. Peace.